You're watching Silver News Daily. Subscribe for more.
And that's why gold is supplanting the United States dollar as the world's reserve currency. That's a functionality of why we see these record-setting prices for gold, which I think are just starting.
The world's financial foundations are cracking right beneath our feet. Stocks are plunging, real estate is collapsing like a house of cards. And the dollar, the so-called safe haven, is crumbling at an alarming pace. But while the majority scramble for answers, silver is quietly preparing to make its most explosive move yet. This isn't just about another minor rally. No, what's setting up right now could catapult silver past $100 an ounce. And that's only the beginning. Picture the chaos of 2008, the volatility of 2020, and the monetary madness of today all colliding into one historic event. Silver has always been the underdog, the overlooked metal. But in times of systemic collapse, it doesn't just rise. It erupts. And with the dominoes falling faster than ever, silver's moment to shine has finally arrived. Stay with me, because once you see the forces lining up behind this coming silver supernova, you'll understand why $100 is just the opening act.
Yeah, so let's start with let's take the stock market first. So I think we're down, as of this morning, I think the S&P was down about 6% on the year after falling about 15%. So we've had a nice rally back. I am completely miffed as to why this is occurring, because I think we are about 3 to 4 weeks away from seeing significant supply shortages on the shelves. If you listen to the importers, 60% of global transportation via vessel is down. 60%, 60. Now China's our second largest exporter. They export about almost $500 billion of goods to the United States per annum, and they're down 60%. So not only that, you've got price hikes in the hundreds of percentiles in retailers. Retailers are scrambling to supplant these sources. They can't find adequate suppliers. So you're looking at layoffs, business closures, empty shelves in a matter of weeks, and yet the stock market is presaging nirvana. So this is remarkable, Donegan. I did some work this weekend. The S&P 500 is still presaging 9% earnings per share growth in 2025. And it's already slapped a 21 times multiple on 9% earnings growth, which is for those who are unaware, 21 times earnings is several times higher. I mean, the average is around 18% earnings. Yeah, 18 times earnings.
Every major stock market crash in modern history has left behind a trail of devastation and a clear pattern. When paper assets collapse, hard assets ascend. In 2008, as the S&P 500 was cut in half, silver initially dipped with the broader market panic, but then soared over 400% in the years that followed. During the 1970s, a decade racked by stagflation and market instability, silver didn't just survive. It exploded from $1.50 to nearly $50 an ounce. And today, the cracks in the stock market are once again becoming impossible to ignore. Companies that once seemed invincible are posting earnings misses quarter after quarter. Debt levels have reached heights never seen before. Consumer confidence is breaking down under the weight of inflation and shrinking savings. The parallels are undeniable, and so are the consequences. As investors flee the stock market in search of safety, history tells us exactly where that capital is headed: real assets, and especially silver. But this time, the collapse isn't limited to stocks alone. It's far broader, far deeper, and it's setting the stage for silver to do something we've never seen before.
Or 21 times a fantasy 9% earnings growth. How do you get 9% earnings growth, Donegan, when economic growth is shrinking by 2.5%, according to not Donegan, Kaiser, or Michael Pento, according to the Atlanta Fed, Q1, GDP growth is shrinking at 2.5%, and you have margin compression from tariffs. How do you get earnings growth of 9%? But even if everything works out well, we are going to see what we see now, the S&P 500 around 5,600. That's the best you can get. And I think that's the assumption comes from decades of inculcation that, hey, the stock market will always go up because either the Fed is going to print money or the government is going to borrow money. So, let's just real quick, after the NASDAQ bubble collapse, what happened? The government borrowed trillions of dollars and the Fed printed it. After the housing market crashed, same thing happened. After the COVID pandemic breaks out, what happens? The market crashes and the Fed monetizes $5 trillion worth of the $6 trillion in COVID spending, helicopter money and mortgage forbearances and all the other things that we went through. So they're looking for an imminent rescue from the Federal Reserve and from the Treasury. It just is not possible to happen at this time. Not with inflation way above their target. The Fed is not inclined to go through any kind of QE or any kind of massive reduction in interest rates anytime soon. And the Treasury at best is going to pass the extension of the TCJA, which is the Trump's the Tax Cut and Jobs Act, which is status quo as far as taxes are concerned. So I think the market is a sell here. I'm not saying it's going to crash, but I certainly wouldn't be chasing this market here. That's the answer to your first question.
When real estate crashes, it doesn't just wipe out wealth. It shatters confidence in the entire economic system. And right now, real estate markets from New York to London to Shanghai are teetering on the brink. Mortgage rates have surged, making homes unaffordable for millions. Commercial real estate vacancies are skyrocketing as businesses shrink or disappear altogether. Cities that once boomed with development are now littered with empty offices and for sale signs. We are witnessing a global unwinding of one of the largest asset bubbles ever created, and the implications are massive. Real estate has traditionally been a store of wealth, but as property values nosedive, investors are being forced to look elsewhere. They're searching for something tangible, something real, but far more liquid than a house or an office block. That's where silver comes in. Unlike real estate, silver doesn't require maintenance, doesn't carry mortgage debt, and isn't shackled to a crumbling economy. As the real estate implosion gathers steam, it's funneling desperate capital straight into physical assets. And silver, with its tight supply and growing demand, is poised to catch that tidal wave.
Comments on real estate. The COVID wave, let's just talk about where everybody moved post-COVID, which was Texas and Florida and North Carolina. For two reasons was the technology was there. Hey, you can't go to your office and you could work remotely. So I was like, listen, I can work remotely. Why am I living in this, very expensive, dirty, highly overpopulated city? Why don't
Authoritarian.
Right. Well, I'm getting to that.
Okay, go ahead.
Part of that was also, and by the way, your kid has to learn remotely, and the schools are closed, and your businesses are closed. So people flooded to Florida and Texas and North Carolina. Those are the states that had the most recipients. So the COVID wave is over, and what's changed in just a few years is instead of mortgage rates being high 2s, low 3s, they're now close to 8% now again. So they were 7%, not 8. Let's not use hyperbole. They're headed to 8 in my opinion, but they're not 2, 3, they're 7% now. Because long-term rates are much higher. In the 10-year, that's what mortgage rates are based off of. So you have much higher borrowing costs. The COVID wave is over, and inventory is now up 30% nationally. 30% in inventory for homes for sale. Days on market is the highest in a very long time, in years. The month supply of home is the highest it's been in years. So what you're seeing now is the most price reductions we've ever seen in history. Home price reductions are the highest they've ever been in history. So you're going to see, instead of, well, my home is going up 10, 20% per annum, and my portfolio is going up 20% per annum, what you're seeing is the exact opposite. My portfolio is down and my home price is rolling over. And that has massive implications for those who have investment home properties, which is like
20-25%
of individuals. All 20 to 25% of all homes are now investor owned. That's either institutional ownership or individual ownership of investment homes. The calculation is very simple. If the home that I'm renting out has a problem with the income stream, where the renter is no longer paying me rent because he lost his job, his or her job, and the home price is starting to fall, why am I paying taxes on this house? Why am I paying mortgage interest? Why am I paying maintenance and insurance? Why am I doing all that?
An association fee.
Yes. So it's very easy to sell your house that's an investment property. You just call your broker and put it up for sale. It's not like you have to worry about moving costs or changing addresses and all that. And it's none of that's involved. So I think the inventory is going to spike even further from here. So the reverse wealth effect is going to be extremely salient.
The dollar's slow motion collapse is no longer just a theory whispered on the fringes. It's happening right in front of our eyes. After decades of reckless money printing, skyrocketing deficits, and weaponizing the dollar through sanctions, confidence in America's currency is evaporating at an accelerating pace. Major economies around the world are dumping dollars in favor of gold, commodities, and even local currency trade agreements. China and Russia have led the charge, but now even traditional allies are quietly reducing their exposure. Inflation may have cooled from its highest peaks, but the damage is already done. Trillions of dollars slosh around the global system, looking for a way out before the next wave of devaluation hits. And here's the critical piece. When the world loses faith in a currency, it doesn't transition into another paper asset. It moves into hard money. Gold may get the headlines, but silver, historically tied to the monetary system for centuries, is the real sleeper asset set to explode. As the dollar continues to lose its grip on global commerce and personal savings, the coming flight to real money will light a fire under silver like never before.
Well, they've been inculcated through decades that, hey, I just wait for the Fed to cut interest rates to zero, and then borrowing costs come down, and then it'll reflate the asset prices. I think the major flaw here, Dunnigan, could be that, which I didn't talk about before, which I was gonna get to, is that when you have these iterations of crises, either recessions or a real estate bubble or a pandemic, and you attack them because you have a fiat currency, you have a tool that you have, it's called the printing press. You abuse two things. So you end up becoming an insolvent nation, and you no longer have a problem with deflation or disinflation, you have a problem with inflation. So now we have an insolvent nation and we have problems with inflation. So when you cut interest rates and go back to ZIRP and QE and spend more money on top of your insolvent condition, what happens is that long-term interest rates might rise, or at the very least not fall very much, as opposed to just following the Fed back towards zero. So you're going to get no relief in the mortgage market. You could actually have a huge problem in the mortgage market as mortgage borrowing costs spike instead of fall, as they usually do in a recession.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active. Inflation was supposed to be transitory. At least that's what the experts told us. But after years of aggressive stimulus, zero-interest policies, and runaway government spending, inflation has become embedded into the very fabric of the economy. Central banks are trapped. If they cut rates to prop up growth, inflation flares even hotter. If they raise rates to tame prices, they risk blowing up debt markets, corporate balance sheets, and national budgets. It's a lose-lose scenario, and silver stands to win either way. Historically, periods of high, sticky inflation have been rocket fuel for precious metals. But today's inflation isn't just driven by consumer demand, it's structural. It's fueled by deglobalization, labor shortages, and energy crises that no interest rate tweak can fix. Meanwhile, the cost of living continues to erode the purchasing power of currencies worldwide. For everyday investors and institutional players alike, there are few safe places left to hide. That's why silver, with its dual role as both an industrial metal and a monetary asset, is perfectly positioned to benefit from this inflationary storm. As faith in paper assets crumbles under the weight of inflation and policy failure, silver's appeal as real uninflatable money will become impossible to ignore.
Interest rate, which is the overnight interbank lending rate, which is what banks borrow from each other. And that's called the money market rate. And short-term interest rates, T-bills, compete with the money market rate. So the Fed controls that very easily, unless they're engaged in quantitative easing, which is direct purchase of long-term treasury bonds. And they have to be very aggressive on that front. An indiscriminate buyer of trillions of dollars of treasury debt, which in itself has a massive inflation implication. Then you cannot say that the Fed controls the whole yield curve dynamic. They control only the short end. And then you have to ask yourself, okay, Mr. Pento, what if the Fed assents to the notion of printing trillions of dollars to engage in QE to just bend down the long end of the yield curve? Well, my retort would be, are they going to buy mortgage-backed securities too? Are they also going to buy commercial paper? Are they going to buy corporate debt as well? Are they going to buy municipal bonds too? I mean, how much debt are they willing to really buy? Because you're going to have a huge problem in the economy. Is the Fed going to supplant the entire bond market, public and private sector? I mean, then you're talking about Zimbabwe. So I don't think they're going to do that. So I certainly wouldn't do it unless there was a massive issue in the economy. You're talking about a depression where both the money market, short-term rates and long-term rates were completely frozen. Repo market frozen. All types of debt was frozen, and they were the only buyer.
While most investors continue to chase the latest tech stocks or cling to cash, the institutions that shape global finance are making a very different bet. They're hoarding hard assets. Central banks, sovereign wealth funds, and even major private investment firms are quietly accumulating gold and increasingly silver. They see what's coming, a world where fiat currencies are no longer trusted, where bonds offer negative real returns, and where tangible assets rule supreme. In 2024 alone, central banks bought more gold than at any time in recorded history, and now silver is starting to catch their eye. The ratio between gold and silver remains historically skewed, suggesting silver is massively undervalued relative to gold. For these insiders, silver offers the same protection as gold, plus the added upside of industrial demand. But here's the kicker. While institutions are steadily building their positions, retail investors are asleep at the wheel, lulled into complacency by a media obsessed with short-term narratives. That's how real wealth shifts happen, quietly, before the masses even realize what's underway. By the time silver starts its parabolic move, it won't be the smart money getting left behind, it'll be everyone else scrambling to catch up.
So, China is one thing. You're right about that. I mean, I want to talk about supplanting demand for our treasury bond market. What about Japan? Japan is the largest holder of our treasuries. And Japan, for a very, very long time, their long-term rates were 1/4%. Less than 1/4% on long duration Japanese JGBs going out 10 years. And now they're close to 1.5. So they have a viable alternative. But then you have to also talk about the trade war, which spiked really the blow up in the bond market. Just think about this. There's two functions here. If global trade grinds to a halt, let's just say there's no longer a huge trade surplus for Japan and China to recycle into our bond market and currency. If that goes away, the bid for our treasuries attenuates significantly. And then you also think about what happened with Russia and these arbitrary, capricious sanctions that we impose on countries. Say, listen, your savings is no longer yours. We're going to confiscate that for you. That started the belief that, hey, what if China is going to have a trillion, or I think it's about $800 billion of their sovereign wealth parked into U.S. Treasury debt, and Japan owns $1 trillion, or whatever is a problem, the United States no longer thinks that they are our friend. I think you can ask Canada about that. What did Canada do to us? Suddenly, Canada, there's a lot of antipathy between the U.S. and Canada. Well, what happens if, for some reason, some administration says, you know what, your sovereign wealth is now ours. We're going to freeze your assets. Does it make a lot of sense to hold a lot of your wealth, your nation's wealth, in another nation that has such fickle behavior? So that, and the fact that there's no longer that big trade surplus to recycle into treasuries, it's a big, big dent in the demand for U.S. treasuries. And you take that, you say, well, okay, if I'm going to sell treasuries and then I'm going to sell dollars, but I don't want my currency to rise, what do I do instead? I sell treasuries, sell the dollar-denominated treasuries, and buy gold. And that's why gold is supplanting the United States dollar as the world's reserve currency. That's a functionality of why we see these record-setting prices for gold, which I think are just starting.
The silver supply story is a ticking time bomb that almost nobody is talking about. For years, low prices discouraged new exploration and investment, and now the chickens are coming home to roost. Global silver production has been declining, even as industrial demand keeps rising at a breakneck pace. Major mining companies have slashed their exploration budgets, and the new silver discoveries being made today are fewer, smaller, and lower grade than ever before. Meanwhile, massive new demands from solar panels, electric vehicles, and high-tech manufacturing are eating through available supplies at an unprecedented rate. The Silver Institute reported consecutive years of structural deficits, meaning we're using more silver than we're producing, and these shortfalls aren't just projected, they're happening now. Physical inventories are being drained, and there's just no quick fix. Opening a new silver mine takes years of permitting, development, and billions in capital, none of which is happening fast enough to meet this runaway demand. When the realization hits that there simply isn't enough silver to go around, the scramble will be fierce, and prices will move in ways that most investors today can't even imagine.
The way it's going to work, Don, again, unfortunately, the way it has worked for many, many years now is you have a job and you fund your 401k, and your 401k closet index the S&P 500, and the S&P 500 goes, it's just an indiscriminate buyer of every paycheck, as the fund flows are incredible towards the S&P 500. And you have the highest valued, because it's a market cap weighted index, you have something called the Mag 7, where you have them equal 40% of the entire index. It's just a function of math and the flow of funds. What I think is going to happen this time around, as we enter into a recession, which I'm almost 100% sure that we're going to see one this year, not sometime this year. We're already halfway there. Q1 is going to be profoundly negative. I would be surprised if it doesn't get even worse in Q2, unless we see an immediate cessation of the tariff conflagration, and we can get into that in a second. But I mean, it's hard for me to come up with a scenario where you're going to have a deal when one side of the argument doesn't even acknowledge the fact that we were having a discussion. So we're going to have a recession, and it might not be that deep, but it's hard for me to make an argument that you can see a flood of buyers for houses and a flood of buying into stocks, because this is, so as I can just finish my thought. So people start getting laid off. They stop funding their 401k when that happens. The market dives 30% or more, 40%. Then finally you get the attention of the individual investor, who is the only one really buying this market right now. The individual investors have never stopped. They have been so surely inculcated to buy every dip because the Fed and Treasury have your back, that they're just dying. This is like an opportunity for them just to, hey, buy every dip.
Behind the scenes, cracks are spreading through the very foundations of the global financial system. Bank failures that once seemed isolated are now flashing warning signs across the entire sector. Liquidity crises are erupting with greater frequency, and the fragile confidence that props up the modern banking system is eroding fast. When banks fall under pressure, trust evaporates, and the flight to hard assets begins. But here's where silver's unique role becomes critical. During times of severe financial distress, silver doesn't just protect wealth, it becomes a form of money itself. Historically, when paper promises collapse, silver steps back into its ancient role as real, tangible money. In a world of rolling bank failures, rising counterparty risk, and systemic shocks, silver stands apart. It carries no default risk, no counterparty exposure, and no reliance on anyone's promise to pay. As financial stress intensifies and liquidity dries up, silver's true value will be rediscovered, not just as a commodity, but as a pillar of survival and security in an increasingly unstable world.
And we can get into a reason why that's not going to work in a second. But so if I can just finish. So unemployment rate spikes, the market drops, the flow of funds into the S&P 500 dry up, and then you get the people who are employed always panic at the nadir of any bear market. They call up and panic and say, hey, they call the plan administrator and say, just get me out of my current S&P 500 fund. I want to go into cash. And then it goes from a 35% drop down to 50% drop. That's when you maybe start getting interest. That's when you see the buying. When you have forced liquidations of hedge funds and forced liquidations of funds in the shadow banking system, you could pick up some really good bargains. I think that's where we're headed because I don't see any other way around it unless you see a significant reduction in interest rates ahead of this, which is not going to happen. Unless you see QE happening very soon, it's not going to happen. In fact, they're still into a very mild version of QT. And unless all tariffs that were imposed from Liberation Day go to zero, not 10, zero, I think you're going to have a very difficult time. Because don't forget, I'm sorry, I know I'm long-winded, but this market was in trouble. The economic situation was in trouble ahead of the tariffs because of the fact that the labor force was shrinking. And the fact that thankfully the government was stopping all their hiring. The government was doing all of the hiring. It was government and government contractors. That's why you say every month the non-farm payroll report was gangbusters because 70% of them was a derivative of what government was doing. That stopped. So you have those two things happening. That's not a recession, but it just means there's no growth in the economy. And when you add tariffs onto that, you get a recession.
When fear finally grips the masses, the shift will be sudden and violent. Retail investors, who today remain largely indifferent to the warnings flashing across the financial system, will panic. The same people who now trust in dollars, stocks, and bonds will scramble to protect what's left of their savings. History shows that when this psychological tipping point arrives, the herd doesn't move gradually, it stampedes. Silver, still undervalued and underowned, will be one of the first assets they rush into. But unlike traditional safe havens, silver has a much smaller market size, making it incredibly sensitive to sudden inflows of capital. A mere fraction of the trillions locked in equities and real estate pouring into silver could send prices soaring past $100 in a matter of weeks, not years. The retail awakening always comes late, but when it does, it accelerates the trend exponentially. Those who position themselves early will watch as silver transforms from a forgotten relic into one of the hottest assets on the planet, driven not just by fundamentals, but by raw, emotional, fear-driven buying.
Well, we have reached, in my opinion, and I've been doing this for 34 years now, so it's not an unlearned opinion. It's one that I've formed from doing this job for decades. I think that we have reached our government's ability to borrow trillions of dollars and have the Fed monetize that deficit and debt without engendering intractable inflation and spiking long-term bond yields.
All the warning signs are converging. Crashing stocks, a real estate implosion, a collapsing dollar, institutional accumulation, supply shortages, banking failures, and a looming retail panic, each force by itself could ignite a silver rally. But together, they're setting the stage for an explosion unlike anything we've seen before. We're not talking about a slow, steady climb. We're talking about a sudden, violent revaluation of silver's true worth in a world desperate for real assets. Every piece of the puzzle points to the same outcome. $100 silver isn't just possible, it's becoming inevitable. And once silver breaks free from decades of price suppression and manipulation, the momentum will feed on itself, drawing more capital, more fear, and more urgency into the market. We are standing at the doorstep of a historic shift, one that could change the financial landscape for decades to come. The setup is complete. The time to act is now, before the headlines catch up and the opportunity vanishes.
Well, the factor is that the fear and greed, it's just a matter of fear and greed. That's how the private sector behaves. So they get most fearful at the bottom of the market. That's just history. And they get most greedy at tops of markets. So this is what's happening today, Dunnigan. I am shocked that when I'm reading reports from imports. I mean, these are reports from people who actually are involved in shipping, global shipping, are saying, "Hey, this is going to be a disaster." Exports from the U.S. to China, pork exports are down some 30%. China has stopped buying many products from retailers here in the United States. Layoffs are happening right now from small businesses. They cannot stay in business when they import most of their goods from China and have to pay 145% duty. They cannot keep the store shelves stocked, so there is no business. So the business lays off. First, they lay off their employees, and then they close down. This is happening right now. I am absolutely shocked as we record this on Monday morning that the market isn't really tanking. It should be for this market to reach fair value based on my estimations. It should be closer to the S&P 500 should be closer to 4,000 rather than 5,600.
Silver's surge past $100 isn't just a prediction. It's the logical outcome of everything unraveling around us. As stocks crash, real estate collapses, and the dollar accelerates its fall, silver is set to reclaim its place as a cornerstone of real wealth. Those who recognize the signs now, who prepare before the stampede, will find themselves on the right side of history when the dust settles. But make no mistake, this is just the beginning. Silver's breakout will mark the start of a much larger financial reset, a global revaluation of what true value really means. If you want to stay ahead of the curve, make sure to subscribe and join us as we track silver's historic rise. And remember, this is not financial advice. Always speak to a licensed professional before making any investment decisions.